That could be it. Lots to complain about, right, Ryan? Oh, dang long weekends ruins everything. If that's what you have to complain about, huh? Hate it. All right, guys, ladies and germs, let's get this party started. It is a Tuesday, the 29th of March, 2016. Forex gates are open. Let's step inside. What was that, Raid 8? Thank you, Kevin. Am I reading a new book? I could be, I should be. I definitely know what I'd like to do. Probably need to go on a 1 month vacation and come back with a book. But anyways, yeah. Hey, let me remind you that trading Forex is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. So please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Beep. Hola! My name is Wayne. I am a currency trader. I've been trading for 10 years. Actually, trading live publicly for 10 years. In fact, I'm coming up to the 10-year anniversary of non-farm payrolls at FX Street pretty soon. Not this month. I think it's next month, right? Anyways, I'm here to share. Oops. I guess I have a yellow goatee. I'm here to share my experiences, good or bad, with the idea that you can learn from what works. You can learn from what hasn't worked, and you can develop your own trading methodology. And the reason that works is because the key to success, I believe, in this game isn't the combination of technical indicators that you use. Okay? And not even necessarily the methodology of which you analyze the markets. It really comes down to basic human skills of risk versus reward, and how you prepare, and the strength to stay disciplined when needed. So anyway, I'm here to share that because it took me blood, sweat, and tears for years, and perhaps it won't take you so long because I'm your mentor. So anyways, we do these sessions every single day, Monday through Thursday here at TradersWay.com and at Forex.Today, and every Friday at FXStreet.com. So good to see you. Swing on by TradersWay.com, open up a demo, and give it a try. I think you'll be impressed. I think you'll find our customer service world class. And maybe one day you'll open up a real account, huh? So let me put you on the desktop here. I need to go through what's happened. One second. Yeah, we'll do technical analysis today. Sorry about that. I just got a million things going on here. No, not that. All right, this one. Okay, what happened in the Asian session? Japanese retail sales. Negative number and a big one. Wow, terrible. But year over year, the first slight improvement. But month over month, not good. So, What do you think about that? That doesn't sound good for someone that has spent trillions of dollars trying to fix the economy, right? Well, maybe I don't know. I'm still going to blame them for raising taxes in the middle of quantitative easing. Even that might not be the case. It's still a pretty bonehead move, right? What else going on? Overall household spending, actually, that was pretty good. So the question is, what are they spending their money on if it's not retail sales, huh? Interesting. Jobless rate, still really good, 3.3. And Korean consumer confidence up a little bit. Whoop, whoop. Ryan, because of the holiday, was updated a day later. Andrew says commentators are talking up the U.S. dollar rate hike end of second quarter. Well, we'll talk about that. We'll talk about that, huh? Yeah, I am seeing a different screen. No, you're just staring at an oscillator. I did make a slide today. Like I said, I was a little lazy. Actually, I wasn't lazy. I was actually doing something else. But anyways, and what else going on? Okay, so it's an interesting, interesting question. How could retail sales go down, but household spending go up? But that's economics for you. Prime Minister Abe reportedly suggested he would only cancel plans to increase the interest rate if there's like crisis, but that ain't gonna happen. Lehman Brothers type crisis, right? So whatever. So that's the big thing, though, right? In the Asian session, I would say that pretty mixed data, and I would say a little more disappointing. There were some good notes in there, but when you get a fall in spend in when you get a fall in sales and an increase in spending, I think it's fair to say that that's a bit mixed, right? And the market may not want to. The market may not know what to do with that. Okay. And blah 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 blah. Eurozone lending data is stabilizing. Great, 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 great. Anything else going on? Hungarian unemployment 6.1. Italian consumer confidence 115. Like, what does all that? What does it all mean? What does it all mean? Right? Italian consumer confidence 115 versus 114. Woo! Wow. Okay. Okay. Great. Great. Load the boat. Right? Yeah, I could put this on a. I could paint this on a canvas and sell it for like $50 million. So anyways, yeah, very mixed bag here. But we're going to get more and more and more and more and more of this sort of inflationary production type data out of the Eurozone. But like I said, we're a long ways from this sort of taking over and being important. There's other things going on that supersede this. And it doesn't seem like we're getting amazing news, but there's more to come the rest of the week, right? And then what's up for today? Well, we know Yellen is speaking, and the TV talking heads. There's one above me actually. I don't know why I don't have. That's Bloomberg. I don't have CNBC going. But they're making a big stink about, we need to pay attention to Yellen today. We need to pay attention to Yellen today. We need to pay attention to Yellen today. And she's not going to say anything new. But you better pay attention. right? But anyway, she will speak. She is the leader, the financial leader of the world, right? So she will say something, and maybe she makes a mistake and says something different. But um, I believe what they've been trying to do is set the table up in April to simply tell us in June they're going to raise interest rates. But I've been saying that for quite some time, right? I don't know how many weeks. I don't remember. Do you find Wayne? Do you find CNBC and Bloomberg report quite differently on? Yeah, actually, I do. All right, a little divergence here for Ryan. I like CNBC during the day, and I like Bloomberg at night. And then while I'm in the shower, because I don't like to waste time, I watch Bloomberg television in the shower. And on the weekends, if you really want to get nitpicky, I meditate in the shower for an hour and a half. Isn't that strange? And I listen to something done by Bloomberg Radio, not by Bloomberg Television. And it's one of my favorite shows, actually. It's something called Masters in Business. So, yeah, it begs the question, like, when do I have downtime? If I'm doing market research in the shower, right? Like, why waste the time? Like, seriously. Right? This stuff here, it's funny. I don't really focus on it, but it helps sort of like loneliness, right? It's sort of like being lost in a desert. Let's say that it's warm at night, because most deserts are cold at night. But let's say you're stuck in a warm desert at night, and you don't need fire for heat, but it's nice to have the light going on. You know what I mean? So I kind of just, every once in a while, I glance up and I look, and I'm like, oh, look, Disney's up. Great. 3M is up. Great. That kind of stuff. And then, oh, look, Egyptian hijackers. Great. Buy the dollar. So, but really, it's I don't know, visual noise. And most of the time, I have it muted, but I unmute it and, whatever. Some at points. But I don't know. It just fills the emptiness, right? I don't have any friends. Okay, so anyways, so there's that distraction. So anyways, so the big news for today is going to be Janet Yellen, what she says, what she doesn't say. I don't think we're going to learn anything new, but the talking head said we should really, really, really seriously pay attention, because she's going to announce a change in central banking policy in the middle of a speech at the economics club or something. Like, whatever, dude. But you never know. You never know. Today, though, Prime Minister Abenomics, he is holding a press conference in today's Asian session. Whoop, whoop. Yeah, that could be interesting. Press conference. What's he going to say? Got Case Shiller coming out. Wasn't important, then it became important for a while, and now I don't think it's really important anymore. Besides, he's from Yale. He's funny though. I'm talking about Schiller. He won the Nobel Prize in economics, not for Case Shiller report. Actually, a student of his approached him. He's like, we should make an index. And he's like, yeah, sure. But typical Schiller, Nobel Prize winner for economics, and I've watched a few of his lectures, and he's not an idiot, but he's smart enough where he just sort of babbles on for an hour and a half, and you're like, I don't know if you said anything, right? I watched one, it was like an hour presentation on the random walk theory. And he kind of babbled on how he knew all the people that wrote the books, and then he tangented this and tangented that, and then he went back to this and went back to that, and then it was all done. And I'm like, I don't know anything else about the random walk theory. I still think I disagree, right? But it was just pretty funny. But you're like, well, but he won a Nobel Prize, so you know he must know what he's talking about, right? Typical Yale, though, right? I went to Yale. I don't know what's going on, but my teacher was a Nobel Prize winner. And then, and then we got industrial production numbers coming out of Japan later. So I wonder if, wonder what's going on that. Okay. Yellen doesn't speak till 11, so watch the London close, eh? I don't give two hoots at 10 about the consumer confidence, right? So some Case Shiller at 9, that's not a bad thing. I don't think it's going to be a market mover. Everything's going to be on par, but I was at a party over the weekend, and someone's real estate agent told them that the real estate market's going to crash again this year. I'm like, really? Why? Oh, well, I don't really know. I'm like, what do you mean you don't know? You can't just say the stock market's going to crash. Like, what data do you have? Because I'm like, oh my God, like everything I'm watching says we're on trend. It'll be okay. Oh, well. So anyways, look, some real estate agent in the backwoods of Georgia says the real estate market's going to crash. So maybe we should pay attention to the Case Shiller report and see how things are going. Sorry. Hang on. Daddy's got business. Hang on. Lost my mouse. Man, that's the thing about having so many screens. Constantly lose my mouse. All right, so let's get to the charts, yo. Mm, 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 mm. Now, it seems to me not long ago we were talking about bottoms, right? Looking for bottoms. Wasn't that it? And I think it may not have been exactly this chart, but one of the things we were doing is we talked about, sticking to your guns, analyzing it, and if you thought fundamentally this was going to go up, you only buy at support, and you look for things like 4-hour and daily oscillators to be overcycled, and then you need to wait for the support. And then maybe you wait for the reentrance here, and that you end up developing plans where you say, well, based on your fundamentals and based on the technical setups, you either buy here or, around that point. So really it'd probably be in here, or it's here and you wait for the same sort of thing down in here, right? Where it comes down, because we don't know. Oops, the oscillator doesn't tell you whether it's going to go up or down. Okay. So first and foremost, you have support, right? And then you look for things like this, right? Isn't this what we were talking about? There's here, and there might have been another one somewhere. One, was it 41 as support? Yeah, well, that's where it flipped basically, right? A little, right? So you throw in psych levels, you throw in pivots, but really price action's a big one, isn't it? And then you look at this low and you say, well, if this doesn't hold, maybe you don't get an opportunity to get in. If it right? If it does, maybe you do. If it doesn't, then you just fall back, right? Fall back to the other one, right? So Keith's already locked in 100 pips profit. Whoop, whoop, whoop. Okay, good job. Now, you may be up 100 and something pips, and then you show me your entry, and I might yell at you. Bad, bad, bad. So it really depends on how you enter, right? Okay. And so if you were watching this area with intent, right? And it jumps, how do you play this? Well, if you're a bear, obviously, you got this junk going on, and you're supposed to sell it at the 21. Am I right? I mean, just a factual statement. There's no debate here. If you're a bear, okay, you sell here. That's it. If you didn't sell here, you're not a bear, or you don't know what you're doing, or you said to yourself, well, I don't like it with the oscillator going up. Good. Fine. Good. Good. That means you thought about it. That's all I'm asking, right? Out of all these years and years and years and years of coaching Forex, that's all I'm asking you to do is go through and look at it, make those decisions. Okay? And I'll tell you why I like that particular situation, because you can change the variables and that would not be the correct setup. Okay? You notice this part? Okay? Does this say trending or range bound? Range. Range, 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 range. And you're kicking off the actual bottom, right? So your target now, doesn't matter if you're a bull or a bear, I couldn't get two hoots in this situation because we're not trending. So the target is here. And then when it's there, the target's going to be back here until it breaks out. So skipping this sell here is not bad. Okay, you could say, well, we're making full cycles here, right? That's the idea. Okay, not bad. Now you could be aggressive and sell it and say, well, I think we're going down there. That's fine. And you wouldn't do that on this time frame, but on a different time frame, let's say the daily supersedes this. So you say, well, based on the daily and down. Fine. Once again, it's as long as you've made the decision process. No, I'm not an ADX guy, Fred. You can. I have nothing against ADX. Just, I don't know. I have enough tools here to make a decision. Right? But like Fred, let's say you totally deleted Stokes and you used ADX, I think you'd be successful as long as you know how to use the ADX. Okay? But a lot of people will say, well, I bought or sold because of this, the Stokes told me so. Well, remember, the stochastics doesn't tell you anything. The ADX doesn't tell you anything, but it expresses the algorithm visually, right? And all it tells you, like stochastics, for example, is telling you what the candles are doing relative to the previous candles. See? Relative to the previous candles, it's coming down or sideways. Relative to those candles, it's moving up. So it's not saying up or down, right? But when you're in extreme situations, extremely oversold and then rising, if you're at support, that would be important, right? Extremely overbought and coming down at resistance, that would be important. Okay, but what's important here? The support and resistance. Because I'll tell you what, if this came down and then went up here, based on this, because bulls were there, then the oscillator would just simply do this, right? It didn't make a decision, right? It's just telling you what's happening in these candles relative to the other candles. So all of this is nonsense if you don't have support and resistance. So as long as you know what your algorithm tells you. So again, the classic situation, Fred, is I give you a chart like this, and I say, draw the MACD. And you're like, well, Wayne, I can't draw the MACD. I'm like, why not? It should be actually a fairly easy process. I could give you a chart that looks like, or let's say you gave me a chart like this. I don't want to delete. Okay, you give me a chart. There's no Stokes, no MACD. I could draw them for you. I can just sit there and I'll draw them. Boop, 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 boop. Oh, this would be doing this. This would be doing that. So as long as you understand what they're telling you and you find that important data, then use it. But most people they follow it like it's magic, and it doesn't make any sense, right? And let's say half the time it works, half the time it doesn't work. And then you're like, yeah, I'll get rid of Stokes and I'll use ADX. Well, it's only because you don't know when to use it, right? So anyway, anything you want, Fred, it'll work. As long as you know what it does and you use that information to make a decision, right? So yeah, so support and resistance. But this could head down if you wanted it and you thought it was. The most important thing is you make the decision. Okay. So like if you did want this to go down, you would say, well, where's the resistance? Okay. You'd probably consider 43, right? 43 as a psych level. 4 hours overbought. You have permission. Okay, guys? Do you pull the trigger on this? No. Okay, but if you thought it was at resistance, and again, this is 43,000, okay, you could have a hypothesis, otherwise known as a strategy. You could say, okay, my strategy here is that this pair should be bearish. Okay, fine. If bearish, it may fall at resistance, in particular if it's overbought. Is it overbought on this time frame? Yes. Good. Do I pull the trigger? No. And then you drop into a smaller time frame. Is it overbought on the 1 hour? Yeah, it's getting there. It's overbought, but it's not falling. So you drop into a 15-minute chart because the 15-minute obviously would fall before the hour, and you start looking for opportunities to sell here on a 15-minute chart. What would that look like? A 5-8 cross down would be nice. But on this 15-minute chart, it would fall, hit the 21, wouldn't it? And then what? It would go up, and then it would fall to the 21, and then it would rise, or to the 55. Then it would rise, and then it would fall to the 200. Somehow, some way, right? For it to make that down cycle on the 4 hour. Great. Well, what would the oscillator look like? Oh, probably down, diverge, oversold, full cycle, and down. There, I just drew the future stochastics that would make that pattern. Would it be an old man easing into a hot bath? Yeah. Except the reason I might not describe it that way is on the 4 hour, I don't see it as a reversal. I just feel like we're in a bunch of choppy sideways action, right? Old man is in particular relative to a change in direction, not just, Greyhound bus going in circles. Yeah. Hunt says it'll go up. Yeah. And I'm not saying it's going down. I'm just saying if you thought it was going to go down, that's how you'd have a trade plan. Because we could argue as a group, right, that whether it's going to go up or down. And my experience is it'll be about 50-50. Right? So Hans says it's going up. Great. Well, maybe I agree with you. Maybe I don't. All of that is totally irrelevant. Right? Because it'll come down to what the big players think, what the central banks think, whatever. What's most important in the context of these strategy sessions is how do you carry out your thoughts, right? If you think it's going up, how do you handle the situation now? Do you buy it at resistance? You buy it at 43,000 on the way up? What do you think, Hans? Yeah, okay, 42 is better. No, but I don't care. Okay, fine. Do you add a second position at 4,300 on the way up? Okay, why not? Hans says no. Why not? Trust, Hans. Hans. Hans, what do you mean? What's trust got to do with it? Yeah. Okay, trust. Okay, but okay, fine. Could just be a translation problem. like the pound dollar's lying to you, right? Stupid thing lies to me. Yeah. No. So cutting out all the moving average stuff. Who cares? By the way, if you're range bound, you don't use your 2155. What does that measure? The market. It measures the direction of the market. But we already agree it moves sideways. There is no market. It's not a bullish market. It's not a bearish market. There's no market. So get rid of it. I only use like stochastics or the 5/8 because what does the 5/8 measure? Price. Well, there's price. Price is either going up or it's going down. Okay. Hans only uses the longer term ones. Okay, good, fine. You're a swing trader. Get it. Love it. I could teach you how to use the other ones better, so you can probably get into some of those trades a little earlier or refine your exits. But that's fine by me. 100 and 200 EMAs or SMAs, fine. In particular, if you're doing things like the stock market, okay, yeah. Big thumbs up if for those settings. Because you're doing basically golden crosses and then retracements of those super cycles. So if I was a bull now on this pair and I wanted to add a second pair, a second trade, so Hans is in at the bottom, right? Great, good. Now, what I would like to see is a break of the psych level. So let's just identify it. And let's get this precise. 1.43. Bingo. Okay, good. So what I'd like to see is a break above and probably not very high. So 143.20 would be my guess. Usually it's somewhere between 15 and 20. Okay? And then it's going to come back somewhere between 80 and 00. And I'm not even looking at this, but of course that helps. And then I would buy it again. Okay, so let's mark that. Let's mark the low side. Okay, it's going to be higher than this, obviously, but let's get it. Okay, so I would look to buy, oh, it's actually pretty close, anywhere down to 40 to 80. Anything lower than that, I'd feel uncomfortable. Okay, and most likely this is going to go up, I would like it to go up, but no higher than 43.20. Anything higher than that would make me uncomfortable. Okay, and that's how I would play it if I was a bull. Okay, wait for the higher high, buy the dip, and this is my buy zone. Okay, if I picked it up at 90 and it started turning green on me, lovely till your mum. Because it would, I would not have the pullback. And most likely, Artem, if we're at 43.25 or 30, it's on its way to 50, and it's not going to pull back. Most likely it'll go all the way to 50 and then come all the way back down to 20, but it also has the propensity to go all the way back to 0.0. So it may reverse at 50. Okay? Usually it doesn't reverse at a midpoint psych, but it can. And it's different, right? Because think about it, if Hans was in at 42 and he's sweating bullets at 43, like, should I take profit, should I not? And all of a sudden it breaks and it goes to 43.50. He's pretty happy, but, that extra 50 pips almost seals the deal. If he's up 150 pips going into the London close, he very well may just take his 150 pips and walk away because he doesn't want to hold it overnight. So psychologically, you're like, oh man, those 50 extra pips, icing on the cake, that's sweet. London's closing, give me my money, I'm going home. Done. And you feel like a hero for the day, right? King for the day. It's street sweeper tomorrow, right? But whatever. Miles, not necessarily, but yeah, it would work out different. So Miles is saying, do I want the Stokes to come down? On this 15-minute chart, if the Stokes comes down, it's going to come down for approximately 2 hours. So if that were the case, am I looking for a 20 pip pullback or something larger? Larger. So my guess then wouldn't be buy it at 80, it would be buy it at 50. Okay, so here. So my guess is down to the 21, and if I'm a bull, that's where I buy and hold. Different scenario, different situation, different price action. So on a 5-minute, it may do this. Okay? I'm long here. Okay? And this would probably go kind of like that. Okay? Depends on the velocity of the rate of change. Okay, if it comes down pretty fast, this isn't even going to move. So if it comes down fast, and it kind of looks like it is, right? This changes the game for me. Because remember, the plan was it has to break the psych level, come back, right? So what if it comes up to 0.0 and then drops like a ton of bricks? Right? That smells like down to the bottom of the range again, right? You know what I mean? Well, it sounds like either someone is selling or Hans is taking profit, right? So again, the psychology of this is somebody bought it at the London Open and now has 100 pips profit going into New York. Book it. So why not buy limit order below psych? Well, again, I need the break. I need the break of the psych. Okay. And then if you're up here and you say, you're going to put a limit, where are you going to put the limit if you're going to limit in? Down here? But what if it only comes down to 89 or 92? So, I don't know. It depends. I mean, on how you like it, right? No, so here, this is an 80-20, guys. So you break 0.0. You want it to go up to about 20. then drop back to 0, 0, and somewhere between 0, 0 and 80 is actually where you buy with the target of 50. Okay? Short term, scalp stuff. So you kind of get this, this, this. And your buy zone on the way down is this area. Okay, now if you do it with a limit order, you totally can, but you could put your limit at 80 and it may only come down to 90 and it takes off and you're never in. Okay, you could buy it at 0, 0, but what if it doesn't bounce between 80 and 20? Or I mean 80 and 0, 0, and just drops down, 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 because you never got something as simple as a 5A cross or a green candle and you blindly bought it. So there's a downside to the limit order. Yeah, I'm not saying you can't. I'm just saying there's a consequence. So my son is going to the state championship for engineering. Yeah, he's third grade, science Olympiad. But they gave him this mechanical engineering. So he was building bridges and doing that kind of stuff. And that's he and his partner did very well, and they got invited to the state championship. Great. And then they're like, oh, by the way, you're going to be tested on something completely new. I'm like, oh, well, that's going to be interesting. Turns out I have 6 weeks to teach a third grader and a fifth grader mechanical engineering and physics. And you get the piece of paper from the school, and they're like, yeah, you got to teach them 12 simple machines. They'll have 45. No, they'll have a half an hour to visit 15 stations. I'm like, that's it? Yeah, like figure it out. Figure it out. Well, what the hell, right? So, but anyway, so what I'm saying is that there's an upside and a downside to everything, if you're looking at the physical world, right? So in this case, you're going to throw down a limit order, and that's cool because you don't have to stare at your charts, right? The downside, okay, there's a downside. So like if you're building a leverage, right, and you need to lift a heavy weight that weighs twice your weight, you would move a fulcrum closer to the weight, and you would have a mechanical advantage of putting downward force here of 50 pounds, but it could lift 150 pounds. The downside is it wouldn't lift it very high. Or if you do it the other way, right? If you now put the weight on the long end and you push down on the effort side, which is the small end, and the fulcrum is still in that spot, you could lift a light weight like 50 pounds very, very high. But you're going to have a lot of downward force on the short side. So the mechanical advantages, you can lift it very, very high, but the disadvantages, you're going to have 3 times the amount of weight. Vice versa, right? So you have to think about what these machines do and the upside and the downside and the trade-offs, right? And how much force and where the force goes and all that kind of stuff. If there's 3 pulleys versus 4 pulleys, what's the difference? And if there's 3 pulleys and you pull down, does the weight go up or down? Depends, right? And so does it change the direction of the force? So there's consequences, upsides and downsides, right? The downside of a limit order is you're not paying attention to things like, did you actually get a trigger? Yeah. Yeah, Ryan. Hey, by the way, Ryan, it's the state championship is the day after my final examination at Harvard. So I have to study for finals and prep these kids for the state championship in engineering. Oh, and by the way, the week before that, Ryan, I'll be in South Africa. Then studying for finals. Then prepping for state championship. Boring. Hoo-ha. Amazing stuff. So anyways, so the trade-off here is, what if this clearly is crashing, right? Let's say it goes up and then just does this. And it's because Janet Yellen says something stupid. and your limit order puts you in, right? But if you were doing it yourself, you wouldn't, right? Because that's what I really like. I prefer to watch. So you get the zero, you get the 20, comes through 0, 0, hits like 90. I love watching around 90, and then it goes choo, 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 and then I just chow, right? I love pulling the trigger, and the stop could be like 75. Okay. Well, Peter says he wouldn't limit right before news, but I think this is where Jimmy's coming from, because this is a decision we have to face day in and day out, and there's not a binary decision. It's not one I always make, okay, or never make. It's like, what do you do if you're Wayne and the London Open is in the middle of the night? So let's say in the Asian session, we make the 20. Do I throw down a limit order at 0, 0 to make sure I get in? Do I play it a little more conservative and throw one at 90? Do I do it even more conservative? Do I do it at 80? Okay. And if so, where's the stop? And if so, if I throw it here at 90, where's the stop going to be? 100 pips? 50 pips? 30 pips? 25 pips? And let's say it's 100 pips, but what if it's a horrible day? I could wake up and like, oh man, it crashed on me, but yet I bought it at 90. And then it went to 80 and then 70 and 60 and 50, and I'm still in it. Why? Because I'm sleeping. I'm like, oh man, if I had only been there, I wouldn't have done it that way, right? Okay. So that's the big decision. And that's something that you always have to decide for yourself. And that can be scary at times. But I'll tell you what, when it works great. But when it doesn't work, it's horrible. Okay, James says the entries seem to be the easy part of trading. Targets and no, actually that's very, very easy. So he says targets and admitting that it's not working is the hardest. Actually, there's a cool way of doing this, James. Okay, one thing that I would encourage you to look at is entering your stop logically, whatever that means to you, putting down a reasonable stop. And the only way you get out of your trade is when you get stopped out. So you don't have any targets anymore. And let's say once a day, if you're a swing trader, you're allowed to move your stop. Okay? There's no target. So once a day, if you're swing trading, for example, you're allowed to move your stop, and you're going to keep moving it once a day until price comes down and knocks you out. The funny thing about this is it's frustrating when the market's moving sideways, and it's exhilarating when you hit a trend, because you keep wanting to get out, but you're like, but Wayne won't let me target out, right? You can't limit out. I won't let you. The only way is you have to be stopped out. And all of a sudden you're like, dude, I have 700 pips on this thing, and I would have bailed a week ago, right? I was super excited at 100. I was sweating bullets at 200, but now I'm up 700, and there's just no way it was going to happen that way. It does happen. Like that scenario, you're like, I would have bailed on this a million years ago with my 75 pips, and that would have been that. But now it kept going. Yeah, it's a manual trading stop. I've never encouraged an actual trailing stop because I think it's a crutch psychologically. Okay. Another one. Do you guys see the little dots on this chart? Yeah, that's that's the Federal Reserve's Federal Open Market Committee's dot plot. Did you know that? That's the dot plot from the FOMC. Sucker! No, that's parabolic stop and reverse. The dot plots, right? No, this in particular works really well on long term. So if you're on a daily chart or a 4-hour chart, peace are the profit pirates, huh? And what it's doing here is suggesting where your stop should be. Okay, the stop is suggested to be right there. So are we long or are we short? Yeah. Hey, Sam, I lost my dot at the bottom of a bourbon bottle. I used to be a tough trader. I used to be a trader. Tough gig. Yeah, so it's short. Okay. According to this chart, you should be short. Okay, and that your stop is right there. And that's the game you're playing here. Okay? And so you could say, like, okay, let's say you longed it in here. Let's say I don't know, you bought somewhere. Let's say you bought this retracement back to the 5 EMA. Your stop would be here. Okay? And you got kicked out along the way, so you broke even. And that's that. And you'll see it's not great like anything else in the sideways market, but you hit some of these trends. Look at, right? You're short this long. Oops, come on, let me do blue pen. You're short this whole area, and this little set of ups, that's where you got knocked out. And then you're short again this whole area. And then you get knocked out right here, right? These are your knockouts. So you took profit, right? Then you're short this whole area here, and then you got knocked out there. Okay? So somebody's playing the inverse head and shoulders on this, right? Okay. Yep. Neat though, huh? So you could also play with that, James, and see if it helps with the target idea. But again, that works best on the long term. Okay, and do you guys remember this? This is our trade plan from, basically 2014, the last days of 2014. Right, we sold it in summer 2015, and our target was 130. I think it was 136.50, wasn't it? Something like that. Conservative target. Okay. The more aggressive target is way down here. Right? So, and we were talking about that here in December and January and February of 2015. Our plan was to have it come back somewhere between the 382 and 618. Well, it came back 50% and consolidated. You can still see I have a giant down arrow. And then I think when we're in about this area, I actually drew this orange line. Like that orange line has been there almost a year now. And a 50% target retracement, right, to basically 160 predicts this drop to 132 or whatever it is. This, the 50% predicts the 1382. Oh, sorry, that is this one. I dropped my 121.4. All right, so yeah, the 50% predicts the 1382. So it predicts here. And we drew this line pretty close to this. So that puts us, about July. So what is that, 8 months ago, 9 months ago? So when those things matter, if you're doing swings, and you may want to do things like, be short, or let's say get short. And once you're short, take profit because things may bounce, and then get back in, take profit. All right, let it bounce, do it again, take profit, and you keep that up until it stops working, right? So according to this, if you're a bear, what you're hoping for, because we don't know if it's going to do it, but that's what you're hoping for, that this sucker keeps going down, right? What you don't want to see is an inverse head and shoulders, okay? And then to add to the funniness, we talked about that happening at the end of the first quarter based on an improvement in GDP. And we did talk about that, a year or so. We didn't know anything about Brexit, though. Right, that wasn't in any of that analysis because there was no such thing as Brexit at the time. Okay? So maybe that's why it's muddled up. But I'll tell you what, though, back in here, and this is when we did it, and I know you guys can confirm it, sort of back in this area, okay, we were doing things like looking at projecting future data that is used to calculate GDP in the UK. And there was a horrible winter at this time. It was freezing cold in the United States and in Europe. And the year before it was freezing cold and terrible in the United States and Europe in that sort of Christmas time. I remember my first 8 weeks of classes at Harvard. Every Monday there was a new snowstorm and they had to reschedule classes and stuff. It wreaked havoc on campus. And so we were talking about GDP, sorry, not Great British, GDP for the UK. And we just talked about things like how is it calculated? What is Carney saying? What are the things? Why does Carney say don't worry about it when the data's so bad? And so on and so forth. And then what will improve? And we talked about, if we get normal weather, which you would have to assume at some point you'll get normal weather, it'll happen in January. Okay, which means when does this data get recorded, guys? A normal January. When does that get recorded? In the second quarter. And we'll look back and this GDP will be better than just this GDP, especially if oil starts going up and not down, or at least sideways and not down. Because if oil in this period, let's say, was down 25%, that gets calculated in all the different things in GDP, right? Because you're spending less, so it's going to be recorded as less spending. And all of a sudden, let's say the decline in oil at this point is 0 versus minus 25%. So that's going to look good because that's a huge improvement. But what if we hit $25 and it jumps to $50 or $40, right? So what if in the third quarter this gets recorded now as not as a negative 25, not as 0, but what if it's up 25%? What does that do to GDP? If you're looking at each of these little components of GDP, right? Consumer spending, government spending, business spending, exports minus imports, all that kind of stuff. All of a sudden you go from recording negative 25 to plus 25, because remember, to get a plus 25 is easy if the prices are low. Right? We're only talking about a $6 to $10 increase in oil prices, and you have a huge percentage. So all of a sudden, like, GDP's got to be way up. But the funny thing, guys, is we had logical, intelligent conversations about what would happen in, at the end of the first quarter is when we'd start tiptoeing in it, was the idea. And certainly we're going to start seeing I think I called them green shoots. Okay, we talked about it here more than a year ago, that somewhere around here, we may start to see an improvement in data. And who knows? If we do see the improvement in data, maybe that's enough of a depreciation in the Great British Pound. Because imagine now they start seeing these dramatic increases in inflation. Because remember, oil going from $25 to $36. Is $36 expensive for oil? No. But it's a 50% increase in inflation in prices. And Miles says, well, that's what Carney was saying. Well, I know. I listened. We talked about it. Right? We're here. I keep showing you that we're here. I don't know. There could be some downside. I didn't talk about Grexit back then because it didn't exist. So it's a new piece of the puzzle. But, if we're up here in November and you're not financially or psychologically or whatever, then you skipped it, man. You skipped it, right? So let me make a point, because it makes me think of stuff we've been talking about recently. Isn't this the kind of stuff you're supposed to be explaining to an investor? Right? I'm trying to teach you the next step always, right? Not just who cares about the 5A cross and the stochastic cross. At some point, that's going to become fairly straightforward, right? But that's still not going to make you filthy, stinking rich in Forex. You know how you get filthy, stinking rich in Forex? Manage $100 million. That would do it. You know what I mean? Are you going to do it on your $10,000 account? Filthy, stinking rich on your $10,000 account? Well, let's say if you keep leverage low and you don't spend any of the money, then yes, in 10 years, you'll do quite well. Yeah, and the ridiculous, sickening worth. Yeah, right on, Andrew. No, you end up, you need to manage money. So let's say in foreign exchange, guys, is it reasonable to say that you would like to be a very conservative, disciplined trader, low risk, low leverage, and earn 10% per year? That's it. Your target for the entire year is 10%. Is that too conservative? Is that too aggressive? Where does that sit? Where does that sit with you as a professional money manager? Is it conservative or is it aggressive? Miles says, is that what we should aim for? I don't know. You tell me. Okay. And then you take that and you say you're going to earn what, 25% of that? Your clients keep 75, you keep 25, whatever you negotiate. Well, Len says many money managers don't make 10%. Well, that would be like stock traders or bond traders, but they don't have. Yeah, I mean that's a different market, isn't it? So you can do the calculations that way, guys. Right? You can do the calculations that way and say, well, to you, what is filthy stinking rich? Is it, is it $10,000 a month? Is it $100,000 a month? I mean, it depends, right? And then just reverse engineer that. Well, what if you only made 10% per year? Now, but as a point of interest, the average CTA in the United States, a commodities trading advisor, which is the term for a fund manager in the foreign exchange market in the United States. I know CTA is a stupid name, but the NFA is stupid. So, but that's what it's called. So if you were a CTA, according to the database at Barclays Hedge, and you can go to barclayshedge.com if you want to check it out. Also, Credit Suisse, something. Credit Suisse also has a database. You can check that out doing some Googling. But according to the stats, and I haven't looked in a while, but I did follow it quite closely for years. So I'm quite certain it'll be very similar. The average successful CTA earns about 2% a month. These are professional money managers with millions of dollars under management, 2% per month. Okay, what does that add up per year compounding? Okay, so that's what your peers are doing. Okay, now they're good. They're the best. I mean, obviously, you're not going to measure yourself with mediocrity, would you? Okay. So 1% a month would be that kind of that 10%. 2% per month would be like that 25%, right? So why don't you use that? Now you'll find right away you're like, holy smokes, I must be so unbelievably over leveraged. Yeah, that's probably true. You probably are over leveraged. But so then how do you get the filthy stinking rich, right? Aspect? Assets under management. So if you're going to manage your own money, yeah, seriously, take 5 years to save money or whatever. But let's say you pop some money in, you take some money out of your retirement account, but not until you've proven that you're a successful trader. So trade on a demo account for 2 years, and then trade on a small, tiny account, but trade it like it's a bajillion dollars, and just show that you can very conservatively over the course of a year earn 1 or 2% a month on your $1,000. Who cares? Some people are like, oh, but the money's so small. Shut up. Just do it. Doing it is what's important, right? And then when you're ready and you're well funded, and maybe you take some money out of your retirement account, maybe you sell your truck, maybe you sell one of your vacation homes, right? I know someone that sold his dog. He went through his garage and the house, sold everything, sold his truck. He sold his dog. I am not joking. He sold his dog and then had this cash and then put it into his trading account. He was that serious. Okay? Yeah, no, it's a total, right? Okay, great. So now he's well funded, right? And that's when you start, then you trade conservatively, but don't be undercapitalized. It's a risk. Because I'll tell you what happens. You're like, I'm doing very well. I've had, 7 or 8 months in a row. Every month I'm producing 1 or 2%, but I can't retire on $20 a week. Right? Evandro says he's got 200 in an account. The only way to, the psychological aspect of it. A lot of people are like that. I'm not like that, but a lot of people are, and I get it. But it's just how we're wired differently, or whatever. Yeah, the upside to also putting in a small live account is that you're always going to get more realistic pricing, and you're always going to get more realistic price action, because if you were managing TradersWay.com, for example, you're a senior leader at the organization, and you have I don't know, I'll make up some numbers. You have 10,000 people with live accounts with real money, and they're in the business of actively trading, and you have 100,000 people with demo accounts. And non-farm payrolls comes out, and the market moves, and there trades. Everyone's trading. These demo guys are trade, and the live guys are trade. What happens to the bandwidth? Okay, so what you'll see in a demo account, and not just TradersWay, but all brokers, because it only makes sense if you're managing the network. Suddenly, when the market goes quiet to like a bajillion trades, the bandwidth, imagine taking, 50 gallons of water and pouring it through a tiny little hose, right? Your goal is not to spill any water. So what you need to do managing this volume of data is to say all priority goes to the live accounts. All priority. And if the demo account, shuts down for 30 seconds and freezes up, don't matter none. Because everything has to be, the live accounts have to be taken care of at all costs. Right? So if they have to suck some data transfer capacity and move it over to the live ones to make sure those are executed, then that's what's going to happen. And then, 30 seconds later, the demo comes back and everything's good again, because these trades were executed. And it has to execute, and it will execute. Okay? Coolio, right? So if you pop in, $500 and you want to use that as a quote unquote demo account, well, you'll always get, good execution and the right pricing and all that normal stuff, because everything makes sure that works well. Okay. So that's sort of the upside. But inevitably, if you are consistently earning 1 or 2% a month, and then you say, well, this is great, but I just can't survive on $20 profit per week. It's like it doesn't make a difference. So what happens is, and you're like, and I've been trading for 7 or 8 months in a row here. I'm good. What happens? Maybe not to you, but what's the cliche? Yeah, I think I'll bump up the lot size a little bit. I mean, I got 8 months of winners, man. Why not just bump it up instead of $20 a week? Why don't I just make it $200 a week? Hallelujah. Good idea. Not. And it's all over. It's just a matter of when, if you die a slow death or, or a quick death, whatever. Right? And yet you don't think like, if I only did this for 3 years and got even better and better and learned some new tricks of the trade along the way, not just swing trading, but some, spot trading and some scalping and some news trading and, all these different types of trading, and building portfolios, half the year and skip scalping the other half of the year. After 3 or 4 years, you're going to be quite a good trader, right? Experienced all kinds of things in the market. And then you walk over to someone that has, millions, or a group of people that have millions or hundreds of thousands, whatever is appropriate for you, right? And you're like, look at what I've been doing for the last 3 or 4 years. And they'll say, oh, that's really interesting. I might want to try that. And you're like, yeah, the cool thing is I'll do all the work. How about you keep 75% of all the profits? I'll do all the work. Don't worry about it. And I'm going to do exactly what I've been doing. I'll just continue along. And they're like, yeah, that's neat. Oh, when I say spot trading, Artem, I'm talking about stuff that you're going to be in for a couple of hours. Usually it's like a 15-minute stochastic cycle. Usually you're picking up 25 to 50 pips. It's like a London Open, but not the whole London session, just like London Open, New York Open, that kind of stuff, right? What you would see on a 15-minute chart. Okay, a swing, I wouldn't be in it for 2 hours. I could be in it for 2 days. Positions are a little more longer, like a couple of weeks to a couple of months. Okay. So anyways, I'd rather you guys focus on, you've made $20 a week your first year, and then that moved up to $25 or $30 a week your second year, and then you're up to like $50 a week in your third year. But at the end of it, you might have tripled very slowly, but over the course of time in many different market conditions. Dollar strong, dollars weak, dollar strong, dollars weak, risk on, risk off, news is good, news is bad, over that course of time, you've very slowly and conservatively tripled your account. You had no huge winning months. You had no huge losing months. It was just all pretty boring stuff. You will be able to tap into global money. And suddenly you have the potential now to be filthy stinking rich. And I say the potential because there is more money in this world looking for something safe that will provide a reasonable return for low risk. There's more money available out there than you could dream of. What we lack is someone that can just do what I just said. What the world lacks is that someone is so patient and so disciplined that they can build a track record of 3 or 4 years and have very boring results. Okay? Your worst month was -2. Your best month was +2. Almost every month was a winner. There was never a big drawdown, both in equity and open positions, right? And they're like, man, this guy's like a steady machine, or this gal is just on the ball. And then suddenly, money flows, and like you're not trading $10,000, you're trading 10 million, and now you're on your way to being filthy stinking rich. Okay, that's how you do it, really. Miles says, what's the average deal with investors? What are they looking for? Miles, that's a very, very, very impossible thing to answer, because what I have found are the investors are different all around the world. Like there's cultural differences. So like, let's say rich people in China, they're like, yeah, we're super aggressive. We're entrepreneurs. My dad was dirt poor. I'm filthy, stinking rich. Let's go. And I'm like, oh, wow, okay, that sounds good. And then he's like, can you guarantee me profits? I'm like, what? What do you mean guarantee you profits? I thought you were aggressive. Oh, yeah, I'm super aggressive. Are you going to guarantee me profits? I'm like, what is this, a bond? Oh, yeah, I'm very aggressive. You guaranteed me. I'm like, sort of like, well, it's strange, It's strange. What do you mean? You're aggressive, yet you want guarantees, and so you're ultra aggressive and ultra conservative. So those are strict or different. In the Middle East, they're like, I'll give you $1 million. If you lose a penny, I'll have you killed. But if you make money, I want you to take all that money and make more money and more money and more money. I want you to turn this $1 million into $100 million. And if you can do it in a year, I'll be happy. If you can do it in a month, I'll be happier. And I'll say, well, you know, that's very interesting. So you're looking for 1,000% per month? Yes. Maybe in 2 weeks if you could do it. You're like, what? And then in America, they're like, oh, so conservative. The more conservative, the better. Hedge everything, because we've been educated in America, because, most people are, their retirement accounts are what's invested in the market, right? So they basically want everything hedged, this idea where you sit down with your money manager and like diversification. Well, that's good if you want a small amount of income and no upside gains, unless every stock in the index goes up. But we go through long periods of time where not every stock goes up in the index. Now that had happened with quantitative easing, right? Sorry, I'm just looking at the view. The view is so beautiful. But anyways, when the market does go up, right? Then okay, great. But what about all the times when some stocks go up and some go down? Diversify, right? Many different companies from many different sectors, and value stocks and growth stocks and all this stuff, right? And what does it lead to? Nothing. How many people got filthy stinking rich through diversification? Can you think of any? Because if you're hedged, it means you don't make any money. Yeah, maybe the fund manager, true. Yeah, the brokers and the fund managers. No, but just if you think about it, if you're hedged, you can't make any money. Diversification is a form of hedging, right? You need to be in stocks and bonds. You need to be in stocks that will go up, and you need to, in sometimes, and then when those stocks are going up, the other ones are going to go down, and and just by sort of financial engineering, you'll never make it. Right? That's why you need a trader. Right? That's why you need a trader. You have a balanced portfolio of all the normal stuff of stocks and bonds and cash and commodities like gold and real estate and all this kind of stuff, right? And you'll be fine. And then you take a small part of your portfolio, like let's say 5 or 10%, and you put that into alternative investments. 1% could go to hedge funds, 1% could go to CTAs, 1% could go to a Forex guy, 1% could go to, I was looking at a fund and all it does is invest into whiskey. All right, give them 1%. 1% goes to art, right? Maybe, all that kind of stuff, right? And you start splitting it around. And the Forex guy takes his 1% and maybe he doubles it in a year or goes for 50%. Meanwhile, your stocks may have gone up 2%, but your Forex guy made 50%. Okay, but you wouldn't do it unless you already had a balanced portfolio. But you don't get filthy, stinking rich being diversified. You stay filthy, stinking rich when you're diversified. There's a difference, right? So if you're undercapitalized, you're not in a position to really to have that focus, right? If you're undercapitalized, I think you should focus on the returns and the patience and the discipline and the focus, right? And if you can put together 1 or 2% a month for 4 years, you'll get there, because your goal isn't to turn your $10,000 account into a $100,000 account, and even then, that's probably not enough to make you filthy stinking rich, right? So what's your goal? Trade your $10,000 account. 3 years later, it's bigger. You never took any risks. Well, you managed your risk appropriately. Never any horrible drawdown periods, right? And then what? You find a way to turn your $10,000 account into a $10 million account, and you keep doing the 1 or 2%. Nothing's changed. Just assets under management, AUM, but nothing else really changes. You're executing the exact same trade. But instead of making, $20 a week, you make 20,000 a week. Good. Maybe that's enough. Okay. So I know someone that sat down with a wealthy individual the other day, and he was trying to structure this deal. And the investor, or the potential investor at that time, just says, well, just wait. Well, why don't I just give you the 10 million? And he's like, well, that's better than what I was going to ask for. And he's like, yeah, why don't I just give you the 10 million and then you pay it back? And he's like, yeah, that sounds good. It was just like, yeah. I mean, literally, it was just like that. Yeah. Oh, well, why don't I just give you the 10 million? We'll work it out. It'll be fine. I trust you. You're good. You're good with me. You're good, bro. Here's 10 mil. And it was just done. Right? If you have returns, there's more money out there than you can dream, where some guy just, without it's nothing. Nothing. How does all that work with regulations? Well, it depends on how you structured it, where you are, who your clients are. So are you a CTA? Are you a fund, like a hedge fund? That's structured differently. There's all different ways. So that's not an easy question either. But yeah, no matter where you are, there's plenty of that stuff. So. Oh yeah, how many people in this webinar have clients? Probably none, David, but a lot of people are interested. So I usually go where the conversation goes. So if I'm off topic, ask more questions early tomorrow, and we'll do other stuff. Okay. So what I'm trying to show you is that you should stay conservative, focused, and disciplined. And you shouldn't focus on making as much money as quickly as possible. You should be focused on growing your account size and lowering your risk or your leverage. Meaning, some of you guys might trade, let's say, one mini lot, yet you only have a few $1,000s in your account. Okay, that's conservative, it's true. But it could be more conservative. So for example, I may choose to trade one mini lot for every $100,000 in the trading account. Right? And so you have more leverage. Right? So if you could grow, so what if you grew your trade account from, $1,000 to $3,000, but you never changed the lot size? Well, now at $3,000, your leverage relative to your account size is actually, significantly less, right? And then so on and so forth. You keep growing it that way. And your first month, you're getting like 50% returns. Your second month, 25% returns. Your third month, 10% returns. Your fourth month, because percentage-wise, right? Because your account size is growing, but your lot size isn't. But what you should be focused on is, are you bringing home 1,000 pips a month, month over month over month? And your 1,000 pips may add to 1%. Your good months could be 2,000 pips. Your okay months are 1,000 pips. Your worst month is negative 1,000. But you would have to have a pretty bad month to lose 1,000. Okay. What Miles says, that's anti-compounding, the idea that actually your winners are getting small. Well, again, it's a percentage, and I'm asking you to grow your trading account while lowering your leverage so that you can survive not just a few months, but that you could be a successful Forex trader for many years to come. Okay? I want you to survive. So, hey, David, are you going to be here tomorrow? Okay. Feel free to ask questions if you want to talk about technicals more or fundamentals more than sort of how we got into this conversation. Just be here tomorrow and ask questions. Ryan, I use Snagit. I think it costs $50. Mark, I would rather do that in the summer. Yeah, Snagit by Camtasia. I think there's only one G in there, no. Snag it. Okay. Yeah, but you guys know, I'm always here, man. Sure, Effendi. But you know what, guys, I don't think people answer these questions in other sources that you may go to. So that's why when you ask these questions, I'll try to stick with it. Like, how many average pips per month should we be making? Okay. Well, that's a tough one to answer, right? But what type of trading are you doing? So on and so forth. What month out of the year? So are you going to make a lot of pips in July? Probably not. I wouldn't expect you to. But you should be able to make 1,000 pips. And usually when I say that, people just fall out of their chair. 1,000 pips! Oh my gosh! Well, that's only 50 pips a day, dude. That's like that's one spot trade per day. Peter says you can make 1,000 pips and still lose money. Wow, then we got a management problem, right? We'd have to work on that. What I've showed you guys lately, like if you recall, I don't know, last month, what was there? I had 28 out of 30 winners with 22 winners in a row. And, well, I made money that day. But then, like a week or two later, I showed you another period where I was basically 50-50, but I still made money. So, obviously there's got to be a management issue in there as well, right? It happens. But, what you don't want to do is like, oh, well, compared to Wayne, what should I do? What should don't worry about me. Okay? Listen to the messages and worry about yourself, right? And so how do you conservatively make 1,000 pips a month? Well, try lowering your lot size and making more trades. If you make one trade a day, you need 100% winners at 50 pips each. Your average winner needs to be 50 pips. And you may not be doing that. Okay? But if you lowered your lot size and made 10 trades a day, at some point, especially when you win more than you lose, your total pips should add up. Okay? I'd rather see you make 1,000 pips in a month on pips, right? 1,000 pips per month, than say, Wayne, I made 10% this month. Like, well, 10%, what does that tell me? Now look at your trades and you made 5 trades this month. Well, that doesn't seem repeatable to me. All right, so you bought it and went up. Good. What are you going to, you're a one-hit wonder. Okay? So I'd rather you make a lot more trades, lower lot size each, but say, Wayne, I'm averaging somewhere between 1 and 2,000 pips per month. Cool. Now, when you hit the summer and volatility drops, that's a beta risk, okay? And I wouldn't expect it, okay? But the beta risk is most likely going to diminish in the good months of September, October, November, December. And if you made 1,000 pips in October, I might yell at you because that might be pathetic. Like, what the hell did you do all month? Oh, well, I got 3 trades and they took off. And I'm like, you made 300 pips on 3 trades. Every single yen pair went up 300 pips a day for 20 days in a row. and you bring this $1,000 pathetic performance here, what the hell's wrong with you? What did you do? Oh, I stared at my charts. You know, like, what? Gee whiz. What's wrong with you? Right? So it really depends, guys. Right? And then the opposite's true. You're like, wait, I made 10% in July. I'm like, what the hell's wrong with you? Nothing happened in July. We moved in the 200 pip range up and down. What the hell did you do? You loaded the boat in the middle of a range with low volume and volatility? You jacked up the risk when nothing was happening? Are you stupid or something? How dare you? How dare you? And you go, but I just wanted you to love me. Right? So it doesn't depend on, it's more than lot size. You know, it's what the market entails, right? You know, should you have a huge winning month when nothing happened in the market? No. Okay? And a sophisticated investor will sniff that out and drop you like a hot potato. And you're like, dude, everyone should love me. I made 10% in July. This is fantastic. I'm such a great trader. And a professional investor will sniff you out and find out you were jacking up risk when it wasn't warranted, and you're out. You're out. You're gone. You are so gone. Okay? You're out the window without a parachute, dude. You're like gone. And you're like, but I'm profitable. I make money. Why don't you love me? Because you're risking my money like a fool. Okay? So that's why questions like that are difficult, because that's the honest truth. I hope you appreciate, you know, the bluntness. Okay? But you should try this. Drop your lot size and make more trades. Not stupid trades, but once you get your trade, you know, you get a good trade in, and you've maybe moved your stop a little closer over the course of an hour, get another trade. Nurse that for a while, move the stop a little closer, maybe get it to break even, get another trade. Get another trade, get another trade. Did I say add 9 losing trades? No. But if you're going to make 1,000 pips in a month, and you have, I don't know, 5 profitable trades open right now, we have 5. Move your stop to break even. Today you go to sleep, and the yen pairs move tomorrow. Risk on. Is it conceivable that they would move about 100 pips each? Of course. So you just made 500 pips plus whatever you had before. So you might be up 750 pips in one day. And I'm like, yeah, well, that's why. If you can't make 1,000 pips a day, you're not trading properly. Or not, I mean, not a day, a month, right? You're just not trading properly. Like, you're not even putting yourself in a position to win. Well, but, you know, I like to trade the 5A cross, and, you know, if I can get 20 pips, I'm happy. Yeah, you're never gonna succeed like that, bro. So that's why I'm here. Right? That's why I'm here. I'm willing to share. Okay? Okay? But just do the math, guys. If you're making 2 trades a day and you're trying to make 25 to 50 pips each, what's your win ratio? Okay? What's your win ratio? 70-30, 60-40, 50-50? Well, if it's 50-50, you don't make any pips. That's it. You don't make any pips. Half the time you win, half the time you lose, you're dead. Your winners are, you know, it's the same type of trade. You're trying for 25 or 50, you're risking 25 or 50, you're dead. So then change it, 60-40, 70-30. Are you really 70% winners? Okay, fine. But then average it up then. How many pips are you making per day? Okay, and you want to make $10,000 a week? Well, what's your lot size? All of a sudden you're like, yeah, you got $20 million on every trade. $20 million on every trade. Well, maybe that's not a realistic plan, right? This is why I did a business plan. Bust out a pro forma cash flow statement and just figure it out, guys, right? Well, if that's not going to do it, then we need to change, man. We need to change what you're doing. Maybe what you're doing is building some good skills, but then now we got to put this over and make you a professional. Totally different gig, right? Right? So yeah, so if you're only making 300 pips a month, I suppose if you have 2,000% leverage, or then you'll be fine. Except you'll probably blow out your trading account. So if we got to figure out a different way, and what you're doing may not be the way, right? But that's why Uncle Wayne's here, because I love you and I want you to succeed. Peace on earth. May the pips be with you. May your profits be above average. I apologize that this was, almost 2 hours. Apologize. Your time is super important, but I'm around. And like I said, I didn't plan for this conversation. You lead it. I go with it. I assume you guys want it. Tomorrow we'll do something else, but yeah, I'm here to help. That's all. If you ask, I'll do my best to deliver. See you tomorrow, huh? Thanks for being on my team. I appreciate it.